Have you ever had that moment on payday? You check your bank account, your salary hits, and for about 5 minutes you feel financially successful. Then the money starts leaving. Mortgage, groceries, fuel, insurance, subscriptions you forgot you signed up for. And 2 weeks later you're looking at your account thinking, how am I working this hard and still not getting ahead? Now, eventually most people start thinking something like this. There has to be a better way to earn money. And that's when you start hearing about things like passive income, or people saying, just live off dividends. Like it's this magical financial strategy where you buy a few stocks and suddenly money starts showing up in your account every few months. Look, here's the thing. Living off dividends is possible, but the internet usually skips the important parts, the math, the discipline, and the risks. So in this video, we're going to break down how dividend income actually works, how much money you realistically need, why 4% dividends might not actually be that exciting, alternatives like ETFs and index investing, the psychology behind why most investors fail, and a real-world example showing the power of reinvesting dividends. But before we start, a quick note. This video is for educational purposes only. Nothing in this video is financial advice or a recommendation to buy any investment. All investing involves risk, and you should always do your own research or speak with a qualified professional before making financial decisions. This video is simply about understanding how these financial strategies work. My name is Jay, and I spend way too much time thinking about practical finance and wealth building that can help improve your life. And today we're talking about one of the most misunderstood ideas in investing, living off dividends. Now look, the internet tends to create two extreme narratives. One group says, you can retire in 5 years with passive income. Another group says, you need $10 million to retire. Both of those ideas are usually exaggerated because the reality is actually much more practical. But to understand it, we first need to understand what dividends actually are. A dividend is simply when a company distributes part of its profits to shareholders. If you own shares in a business, you are technically a part owner of that company. And sometimes businesses share their profits with their owners. For example, companies like Coca-Cola, Johnson & Johnson, and Commonwealth Bank have historically paid dividends to shareholders. Again, these are simply well-known examples used for education, not recommendations. But the idea is simple. Companies make profits. Some of those profits are distributed to investors. If you own enough shares, those payments can eventually become income. Now let's answer the question everyone wants to know. How much money do you need to live off dividends? The formula is actually very simple. Dividend income equals portfolio value times dividend yield. Dividend yield is simply the percentage of your investment paid as income each year. Historically, many dividend-focused portfolios produce yields around 3 to 5%. So let's use 4% as a simple example. If someone had $500,000 invested at a 4% dividend yield, they would receive $500,000 times 4%, $20,000 per year, which works out to roughly $385 per week. Not retirement money, but it demonstrates the math. $1 million portfolio. $1 million times 4% equals $40,000 per year. $1.5 million portfolio. $1,500,000 times 4% equals $60,000 per year. $2 million portfolio. $2 million times 4% equals $80,000 per year. Now this is where people react in two different ways. Some people think, $2 million is impossible, but others realize something interesting. You don't start there, you build toward it over time. But before we even go further, there's something important we need to talk about. Why 4% might not be that exciting. Here's what most people don't realize. A 4% dividend yield isn't actually that impressive today. Because right now, many high-yield savings accounts are paying similar rates. Savings accounts regulated through organizations like the Federal Deposit Insurance Corporation have recently offered rates around 4 to 5% in some cases. And the big difference? Savings accounts carry far less risk than stocks. Now, we actually have a separate video on this channel explaining high-yield savings accounts and when they make sense. So if you're new to investing, that video is definitely worth watching. But here's the catch. Savings account rates change constantly. Sometimes they're 4%, sometimes they're 1%, sometimes even lower. And over long periods of time, savings accounts rarely outpace inflation, which is why many investors eventually move into assets that can grow over time. And that brings us to ETFs. Instead of trying to pick individual dividend stocks, many investors choose exchange-traded funds, or ETFs. ETFs are simply funds that hold many companies at once. Examples include Spider S&P 500 ETF Trust, Vanguard S&P 500 ETF, and Vanguard Total Stock Market ETF. These ETFs track large stock indexes like the S&P 500. Historically, the S&P 500 has produced roughly 10% average annual returns over long periods, according to data from Standard & Poor's. And over the last decade, the returns have actually been even stronger in some periods, often averaging roughly 12 to 14% annually depending on the time frame. Now that includes both price growth and dividends. But we need to be very clear about something. Past performance is not a guarantee of future performance. Markets go through cycles, returns change, and stock markets can also fall dramatically in the short term. Now you might be thinking, if ETFs can produce 10% returns, why doesn't everyone just invest in them? Because higher potential returns usually come with higher volatility. During the COVID-19 market crash, the stock market dropped more than 30% in just a few weeks. That kind of volatility can be emotionally difficult for investors, which is why some people prefer safer assets like savings accounts. Others prefer the long-term growth potential of stocks. There is no perfect solution, only trade-offs. Now let's come back to dividends, because here's what most people don't realize. Dividends are not just income, they can also be fuel for compounding. When dividends are reinvested, they buy more shares. Those shares generate more dividends, which buy even more shares. Research from Standard & Poor's shows that dividends have historically contributed roughly 40% of total market returns. That's a huge portion, and this is where the real difference appears. Let's look at two investors over 15 years. Both investors start with $200,000. Their investment produces 4% dividend yield, 5% price growth. Total return potential, roughly 9% per year. Again, this is a simplified educational example. Investor 1 takes the dividends as cash income. Every year they receive $200,000 times 4% equals $8,000 per year. They spend that money. Over 15 years they collect. $8,000 times 15 equals $120,000. Meanwhile, their portfolio grows from price increases. After 15 years, their portfolio is worth approximately $415,000. So their total wealth looks like this. Portfolio value, $415,000. Dividends received, $120,000. Total value created, $535,000. That's a 167% return on the original investment. Not bad. Now let's look at investor 2. They reinvest every dividend. Each dividend buys more shares. Those shares produce more dividends, which buy even more shares. After 15 years, their portfolio grows to approximately $728,000. Same starting investment, same market, same companies. But the difference is $193,000. Simply from reinvesting dividends. That's a 264% return. And here's the key insight. The longer the time period, the bigger that gap becomes. Now here's the surprising part. The biggest barrier to wealth building isn't math, it's human psychology. Research from Dalbar has shown that the average investor historically earns significantly lower returns than the market. Why? 3 behaviors: panic selling, chasing hot investments, and trying to time the market. Look, when markets fall 20%, people panic. When markets rise 20%, people feel invincible. Both reactions can lead to poor decisions. Long-term investors tend to focus on consistency instead of prediction. Now this is where it gets really interesting. Most people think the goal is retirement. But dividend income can create something even more valuable: financial flexibility. Imagine earning $500 per month in dividends. That might cover groceries. $2,000 per month could cover rent. $5,000 per month could cover most living expenses. At that point, work becomes a choice rather than a necessity. And that's the real goal, not luxury, freedom. Before we finish, a final reminder. This video is for educational and informational purposes only. It is not financial advice. All investments carry risk, including the risk of losing money. Past performance is not a guarantee of future results. Always do your own research or consult with a qualified financial professional before making investment decisions. If you enjoyed this video, make sure you like and subscribe to the channel Infinite Wealth Education. This channel is all about helping people understand practical finance, investing, and long-term wealth building. And I'd love to hear from you. What financial topic would you like us to break down next? Leave your content requests in the comments below. Because the goal here isn't just learning about money, it's building a future where money works for you.